All right, today we're going to tackle one of the biggest, most predictable shifts happening on the entire planet, the age of aging. And look, this isn't just about people getting a little older. This is a fundamental rewiring of our whole economy, and it's creating this massive investment opportunity that, frankly, most people are thinking about in completely the wrong way.
So let's just start with a really big question here. What if the whole idea of working till you're 65 and then just kicking back for 20 years, what if that's just over? Because, for millions and millions of people, it is. The financial math that worked for our parents' retirement, it's just falling apart. And this is creating a huge societal problem. But where there's a problem on this kind of scale, well, there is always an opportunity.
And believe me, this isn't some far-off abstract thing we're talking about. It's happening right now, as we speak. The single biggest demographic wave in modern history is crashing onto the shore. It's creating something people are calling the inverse pyramid. And get this, for the first time in human history, our planet has more people over the age of 65 than under the age of 5. That one single fact is the trigger for everything we're about to get into.
So here's how we're going to break this down. First, we'll dig into why retirement as we know it is ending. Then, we'll debunk the most common and honestly the riskiest way people try to invest in this trend. After that, we'll get to the main event, the longevity arbitrage. We'll get technical on how to actually invest in longevity infrastructure. Then we're going to face the single biggest risk to this whole idea. And finally, we'll zoom out and talk about what this means for building a portfolio that could actually last a century. Okay, let's just rip the Band-Aid off and start with the hard truth. The traditional model of retirement is failing. It's this quiet crisis that's about to have some very, very loud consequences. And really, understanding this problem is the key to seeing the investment opportunity that it creates. The numbers here are, well, they're pretty stark. A study from the Retirement Income Institute is sobering, to say the least. 2/3 of what they call peak boomers, that's the youngest of that generation, are on track to be financially challenged in retirement. I mean, just look at that chart. That is a huge majority. We're not talking about some small, unlucky fraction here. We're talking about most people. So, how did we even get here? Well, a huge part of the story is this massive shift from then to now, just like you see on the slide. You had an entire generation that entered the workforce right as those stable company-funded pensions were vanishing. The promise of a guaranteed check for life was replaced with a 401k, a system that basically said, hey, good luck, you're on your own. It put the entire burden of saving and investing right on the individual. And for a lot of people, that burden was just too much. Okay, so when most investors hear the word longevity, their brain immediately jumps to one place. But as we're about to see, the most obvious bet is often the most dangerous one. Let's just call it what it is, the sucker's bet. Right. The common wisdom tells you to go find that next revolutionary biotech startup that's going to cure aging or help us all live to 150. And hey, that's an exciting idea, right? But from an investment point of view, it's a lottery ticket. It is a binary win or lose gamble on incredibly complex science and a brutal FDA approval process. It's a super crowded trade, and for most investors, it's just a fantastic way to lose a lot of money. And this brings us to the core of this whole thing. If chasing the miracle cure is a lottery ticket, where is the real, predictable opportunity? Well, it lies in a simple but really powerful concept we're calling the longevity arbitrage. So here it is, the formal definition, and this is where things get really interesting. The longevity arbitrage is all about the gap between speculating on the cure and investing in the care. Because think about it, whether we live to be 80, 90, or 120, a massive growing population is going to need specific services, housing, and infrastructure. This is the silver economy, and it's projected to be a $15 trillion market. The real opportunity isn't in the cure, it's in the care. This slide just lays it out perfectly. Investing in biotech is like drilling for oil. You spend a fortune, you drill a bunch of holes, and you hope you had a gusher. But most of the time, you just come up with dirt. The longevity arbitrage is about owning the pipeline. You don't care who finds the oil, you just get paid for every single barrel that flows through. It's a total shift from speculative, maybe revenue, to stable, recurring, predictable income. Okay, so how do you actually own the pipeline? Let's move away from the high-level idea and get into the practical nuts and bolts of how you would actually execute on this strategy. So the main tool we're going to use for this strategy is a special type of company called a real estate investment trust, or a REIT. The easiest way to think about it is like a mutual fund, but instead of owning a basket of stocks, it owns a whole portfolio of income-generating buildings. It's a way for you to invest in huge, large-scale real estate without having to go out and buy the properties yourself. And the business model is actually pretty simple. This slide breaks it down. Step 1, the REIT owns the actual physical properties, like senior living communities. Step 2, they then collect rent from the companies that actually operate those facilities. And step 3, this is the crucial part. By law, REITs has to pay out most of that rental income to shareholders in the form of dividends. It's basically the ultimate landlord model, just scaled way, way up. Now, not all REITs are created equal. As you can see from this table, they can own anything from office buildings to warehouses to apartment complexes. But our focus is really, really narrow. We are laser-focused on one specific corner, the healthcare REIT sector. We're targeting the companies that own the physical infrastructure, the senior living facilities, the medical buildings that are directly in the path of this unstoppable demographic wave. And for anyone who's ever thought about maybe buying a rental property themselves, this is a huge advantage. When you compare it to all the hassle and risk of owning a property directly, REITs give you a diversified, professionally managed, and liquid way to get that same exposure. As the quote says, they're generally the safer and more beginner-friendly option. And let's be super clear here. We are not talking about your grandparents' nursing home. This is Senior Living 2.0. These are sophisticated, almost hospitality-focused communities that are built around active lifestyles and personal autonomy. They are more and more tech-heavy, with things like telehealth and smart home features built right in. All of this requires a totally new kind of physical infrastructure. And the REITs, they're the ones who own it. Okay, so far, this all sounds almost too good to be true, right? You've got a predictable demographic trend fueling a stable, income-producing asset. But every single investment thesis has an Achilles heel. And for this one, it is big and it is brutally simple. Because it doesn't matter how solid the demographics are. It doesn't matter how well-run the facilities are. The entire business model can be turned completely upside down by the stroke of a pen in Washington, D.C. So here's the hidden risk, the catch. The tenants in these buildings, the actual operators, get a huge chunk of their revenue from government programs like Medicare. So, if a new law gets passed that changes how much the government pays them back for their services, it can absolutely crush their profitability overnight. And that starts a really dangerous chain reaction. If the operator can't pay their rent, the REIT's income is at risk, which means your dividend is at risk. It's a critical reminder. Demographics plus policy equals the future. You cannot ignore the policy part of that equation. And this isn't just some abstract risk for our investment idea. As this quote points out, longevity risk, the risk of people living longer than expected, is a massive source of stress for the entire financial system. From giant pension funds to insurance companies, it's a systemic problem, and government policy is the ultimate wildcard in all of it. So, let's wrap this all up and bring it home. We've gone through the problem, we've debunked a common myth, we've defined the opportunity, and we've stared the biggest risk right in the face. So what is the final, most important takeaway from all of this? The real lesson here goes way beyond just one investment idea. It's really about a fundamental shift in your mindset. The old way of thinking had this clear, bright line between work and retirement. But as our lifespans get longer, we all have to start thinking on much, much longer timelines. A potential 100-year life means you're not funding a 20-year retirement anymore. You might be funding a 40 or even 50-year one. And so I'll just leave you with this final thought. The old rules said you work for 40 years to fund a 20-year retirement. Simple enough. But what happens when you might live to be 100? Suddenly, that's a 40-year career that has to fund a 40 or maybe even a 60-year retirement. The math is changing for every single one of us. The question is your portfolio built for it?